The broadcast is now starting. All attendees are in listen-only mode.
Hi everyone, thanks for joining. We're going to wait for another minute or two to allow folks to join and then get started.
Hi everyone, this is Cindy Zhu from the Department of Energy. Thank you for joining us this afternoon to participate in our webinar focused on commercial mortgages, how energy can be factored into mortgage loan default risk. We have some great speakers with us today that are working with us on this project from UC Berkeley and also the Lawrence Berkeley National Lab. I will let them introduce themselves in a moment, but first I'd like to remind everyone to please use the chat box to ask questions throughout the talks. We will be looking for questions throughout the speakers' presentations, and we can pause them and have them answer the appropriate questions while they are speaking. We will save time at the end of the presentation to open the floor up for comments and more questions. So you can either choose to continue using the chat box or use the raise hand function. If we see that your hand is virtually raised, we can open up your audio controls and then you can speak your questions. If there are any glitches at all, just please remember that the chat box is open and we'll be constantly looking for your questions to field to our speakers. All right, next slide, please. All right, first up we have Paul Matthew. Paul, do you want to do a little introduction about yourself and then go ahead and get started?
Sure. Thank you, Cindy. Hi, everyone. This is Paul Matthew. I'm a staff scientist here at Lawrence Berkeley National Laboratory. I'm just going to kick things off to provide some premise and context, and then I will be ably supported here by two co-presenters from the Fisher Center for Real Estate at the Haas School of Business at UC Berkeley. That's Professor Nancy Wallace and Paulo Isler as well. So this is just a quick outline. We'll just have a few slides on the premise and context, why look at commercial mortgages, and a quick note about a DOE scoping study we did. And then we'll go straight to our feature presentation, which is a new and exciting results on looking at the impact of energy factors on mortgage default risk. We're quite excited by these, or as the millennials here in California say, we are stoked about these results. So next slide, please. Okay, you can go ahead. One more. Okay, so current commercial mortgages currently do not really fully account for energy factors in underwriting and valuation, and particularly as it relates to the forward projections of energy consumption and price volatility. And as a result, energy performance and therefore energy efficiency is really not properly valued, and energy risks are not properly assessed and mitigated. But we think that commercial mortgages, we think, I should say we know that commercial mortgages are a very large lever. They're a $2.5 trillion market, and could actually be a significant channel for scaling efficiency as well. So that's kind of what prompted us to look into this. And with that, given that that prompting, the Department of Energy commissioned us to do this scoping study. So if you could go to the next slide, okay. And I just want to present a quick couple of findings from that scoping study. So what we did was that we conducted first a pretty exhaustive literature review, and surprisingly, there actually wasn't a lot of literature on the impact of energy factors in commercial mortgages. And then we also held about 40 stakeholder discussions, mostly with lenders and owners, but also some service providers and various industry organizations and their representatives, primarily to look at the state of the market, what current practice looks like, and what the potential interventions might be. So on today's presentation, we don't have the time to get into the details of the scoping, of the findings in the scoping report, but it is available as a public domain document, and the link here is here, and everyone I think will be getting the slides, so you'll be able to review this at your leisure later. Next slide, please. Okay, so the way we're thinking about these interventions, here's a schematic that kind of illustrates that. So on the left, in the green box, you have what might be sort of drivers of mortgage value that are energy or green related. And there are quite a few studies actually out there now that kind of relate. Some of them are anecdotal, of course, but that relate green features or energy efficiency features to increased rental income, to reduced vacancy rates. And of course, we know for a fact that more efficient buildings have lower utility costs, and as well as potentially lower utility cost volatility. And off on the right are the potential outcomes that could come from that if they're properly incorporated into the mortgage process. So the outcomes are really that it should be reflected in greater property value, potentially lower interest rates because of less risk in terms of energy cost risk. Also potentially better terms in terms of loan-to-value limits or debt service coverage limits. So right in the middle there are what we've kind of highlighted as our key intervention points. The first is appraisals. The second is around underwriting methods and requirements. And the third is around property condition assessments. So if you could go to the next slide. So with that, we have 3 efforts underway right now. The first is what we call move the needle analysis, which is simply to demonstrate to lenders why, where, and how much these energy factors actually move the needle on key underwriting. Because what we heard from the scoping report was that this sounds interesting, and yes, it makes sense logically, but we'd like to see some actual analysis of how much it moves the needle. And that's today's presentation. But I just want to quickly mention that we do have efforts underway in the other 2 areas. We are looking to incorporate PCAs energy efficiency into the property condition assessments, and also looking at incorporating efficiency routinely into appraisals. And we'll have more information about both of those actually at the end of the presentation, because we'd definitely be interested in continued engagement from the stakeholder community here. Next slide, please. All right, so let's go straight to the feature presentation here. So let's look at just, again, energy cost factors and how it affects valuation in terms of net operating income. So net operating income is essentially your gross income that you get from your rents minus operating costs, of which there are many, and with a particular one we're interested in is energy cost. Energy cost can be thought of as consisting of 2 key components. There's a volume component, which is how much electricity or fuel am I actually using. That is driven by building features, operations, and weather, as I think most of us understand here. But then there's also a volatility to that volume, to that use, which is driven by operations. And I think many of us know anecdotally that sometimes you get a really good facility manager and suddenly the building gets much more efficient without any changes in the actual assets. Or of course, you may have a very hot year or a very cold year, and that can change your volume as well. And then the second key component is price. And here again, it's the actual, the fixed value of the price itself, and then how that price may vary over the course of the mortgage term. So our question that we sought to address in this analysis was, how do these factors in fact affect NOI and mortgage default risk? Next slide, please. So ideally, from what we know about lenders and the kinds of data they're interested in, they want to see empirical data. And we'd have ideally an analysis on an empirical data set that has time-variant data on energy factors for specific buildings, matched with loan performance data for those same buildings. And that's a fairly representative sample across different market segments. Well, that's a nice wish, but you know, Santa Claus isn't around for this sort of data set. I mean, the challenge really is that there's a lack of time-variant consumption data that can be matched with loan data. There's a lot of anonymized data that's around, but very hard to get, you know, very specific building data, and also a lack of tariff data for individual buildings. Certainly to get it at the scale that we're interested in. Next slide, please. So what we did is we looked at a bunch of data sources, and we don't, in the interest of time, I'm not going to go into the details of each of these data sources here, but suffice to say that for loan data, we used a data set called TREP, and Nancy and Paulo may say a little bit more about that as they talk about the analysis, combined with energy price data from the ISO and the RTO. And for energy use data, again, because we wanted empirical data for known buildings, not just anonymized buildings, but known buildings that we match, we decided to use the benchmarking disclosure data that comes out of several cities now. Next slide, please. So with that, I'm going to hand it over to Paulo Isler, our team member here, who's now actually going to talk about the model that was constructed, and then Nancy will follow with the results of the analysis.
Hello, everyone. Thank you for attending. My name is Paulo Isler. I am the lab director for the real estate and financial markets at the Fisher Center. I'd like to highlight in this picture our key approach for modeling how key components would affect mortgage default. So on top of the page, we have that expression that shows that mortgage default is basically a function of several factors, and going from right to left. First, you know, the region where the property is located. That would be an indicator of economic conditions that may drive mortgage default on a different fashion across, you know, different regions. Another key component, and these are pretty much traditional of the financial markets to analyze mortgage default, is the loan-to-value ratio. At the time the commercial operator enters into a mortgage, there is a property value, and the loan-to-value ratio is a key indicator, or is a key element that translates into the risk of the mortgage. So the higher the loan-to-value ratio, the higher the risk of the mortgage getting into trouble in the future. Another element has to do with the interest rate markets. That is another key traditional driver of mortgage default, which is what we call the coupon gap, which is the difference in the mortgage rates at the time of mortgage origination versus the market rates that the building operator or the property owner can refinance the mortgage in the future. So, of course, you know, the higher that coupon gap, meaning the higher the interest rates has moved relative to the interest rate at inception, the higher the risk of mortgage default. Now comes two elements, which is the novelty that we're bringing into our analysis here, which is the EY, or the energy intensity of the building, energy unit intensity of the building, and the energy price gap. I think the energy price gap deserves a little bit more description here, and I'll like to go to the next slide so we can explain that a little bit better. Next slide, please. So the energy price gap is basically what we're using, as Paul mentioned before, as a proxy
Hey, Paulo, I'm going to pause you for 1 second. We do have a question that I think is important before we move on. Somebody asked, what is the ISO RTO data set that is being used for this model?
Yes, of course. The ISO is called the Independent System Operators. These are institutions, or these are organizations that basically coordinate the dispatch of the grid on a large scale. So they basically covers the electricity grid on going over multiple states, covering an area that goes over multiple states. And they basically optimize the dispatch of the grid, meaning they tell which plants need to be run and at what time and in which fashion, so that the grid preserves its reliability. And at the same time provides the electricity demanded by the what we call the load serving entities of that component of the grid, mainly the utility companies, which ultimately distribute, the energy to the buildings. So that's the role of the ISO. The key data that we got from the ISOs are the wholesale electricity prices, meaning these are prices that that the utility company will have to procure in the market to provide and purchase, from these power producers to provide the necessary load to fulfill the demand of the system. So basically, that's what the ISO is, and that's the kind of data that we collected. So going back to the energy price gap now, what we are doing then is using that ISO data, wholesale electricity data, to construct a proxy basically for the what we call the unexpected energy expenditures. Think of the energy price gap as analogous to the coupon gap. It tracks along the life of the mortgage how much pressure the energy cost is putting over the net operating income, and which is going to be ultimately a driver of mortgage default. So think of this, if a building operator is facing month after month, a much higher energy cost or energy prices than what was initially forecasted at the time of the mortgage origination, that may prompt the NOI, or that may push NOI to lower and lower levels, but will ultimately be driving the mortgage default. So the way we build this variable here as an explanatory for mortgage default is defined by that as the expression on the slide. I'm not going to go over all the math there, but basically we are accumulating these price differentials along the life of the mortgage, and keeping track of that up to the time of mortgage termination, either it's the mortgage default or if the mortgage terminated as contracted. So LMP is basically what we call the locational marginal price, which is the data that we collected from the ISO, and the historical LMP is the forecast, is the prices that has been faced by the building operator at time of origination, and that's what they would use to forecast what the energy cost would be in the future. So by keeping track of these differences, we expect to explain mortgage default. Next slide, please. This is a very quick example. I'm not going to go over all details, but it shows, how at S0 equal T naught over there, that's the time of mortgage origination. You can see there are 12 historical prices marked in yellow over the past 12 months. And as the mortgage goes along, over the timeline, we keep tracking this difference in the realized price versus the historical price, and we keep accumulating that, and that's how the energy price gap is constructed.
Next slide.
So next slide. So good afternoon, everyone. I'm Nancy Wallace. I'm a professor at UC Berkeley in the Haas School of Business, and I'm chair of the Fisher Center. And the lab, as Paulo introduced, he's our empirical director, and I'm co-chair of the Fisher Center. And we are very focused on mortgage default analytics at Haas, and so this project was right up our alley, but really with a twist that we'd never explored seriously. So this has been quite exciting for us in terms of looking at different data and trying to connect the dots to see whether or not, as Paul set out our task, to see whether or not accounting for energy carefully really does move the needle in understanding the incidence of default among specific buildings. So as Paulo said, for the model that he was going through, the schematic, we're looking to model the probability of default for specific mortgages, for a data set of specific mortgages that we track over time. So the data that we have are mortgage data that have been merged with the benchmarking data that come from the cities. And then we track those data on a monthly basis to see what their performance is. And we are treating default in our data set as either 90-day foreclosure or REO. So typically if people go into 90-day delinquency, they don't emerge from it successfully. So that's our measure of default. And we are looking at an array of variables, as Paulo summarized them, some of which are fixed at origination, things like the difference between the contract rate on the mortgage and the current interest rate on that origination timing. And then things like the original loan-to-value ratio, information about the structure of the mortgage, how long to its final maturity date, when the final balance is due on the loan, and then information about the year it was originated and other features of the mortgage that we know at origination. And then we're tracking these loans over time, and that's where the information on the source EUI, we're going to look at 3 different measures, source EUI, site EUI, and Energy Star. Those are the information we have from the benchmarking data. And then we'll also have the electricity price gap, which we're tracking over time. So for each month on these mortgage originations, we track these over time. So this was a big effort in terms of merging data sets that had never been merged together before, of the ESO data that was relevant for that building, all the mortgage data over time specifically, and then all the information about the buildings themselves, which we also have in this data set, merged to their energy characteristics. The first, what we're looking at here is just a table of a regression where we're trying to anticipate or fit statistically what the effects of these characteristics of the loan and the property and its energy exposure are relevant to its observed levels of default. So each building we're tracking, it either is current until the end of the period, and we're tracking these data over a period of time between 2000 and 2016, so that we're looking month by month for all the mortgages that were originated over this time period from the first day of their origination, because we have the date of origination, until the end of the period. And so the way you are observed in this sample, you either survive until the current period 2016, or you die because you have defaulted. And so what we do is run these regressions, and as you can see, many of these explanatory variables are highly statistically significant, which is quite interesting in that this is quite a small sample. It was a laborious effort to merge to these various data sets that were never intended to be merged, but we are finding very strong results. And if you could turn to the next slide, please, which we've summarized on the next slide. Rather than look at the numbers in the slide, what we thought we'd do is summarize what the bottom line is, what the key results are. And basically the first estimation, our two energy factors are the usage variable, which is the source EUI, which we take logs of because it's a very skewed variable, and then the energy price gap, or the electricity price gap. So those are our key variables. And what we find is that both the electricity price gap and the source EUI are highly statistically significant at normal cutoff levels. So even with this small sample, we're finding that there's a very important correlation between the source EUI for these specific buildings and what a treatment effect, if you want to think of that, of being exposed to variable electricity prices over the experience of the mortgage. So not only are these statistically significant, but obviously what all of us are really interested in is, are these economically significant? Do they really affect default levels in a meaningful way? And the answer to this also is really quite interesting and positive. So what we find is that the higher the source EUI, the more energy usage per square foot, the higher the likelihood of default. And these, Paul is going to spend more time right after I finish this section of the webinar talking about exactly what that means quantitatively and relative to overall default levels. So it's relatively meaningful. It's about a 10% increase in default levels. Okay, so we also find that the higher the electricity price gap, in other words, the larger the difference between the realized and the expected electricity prices since the loan origination, the higher the likelihood of default. And again, we're modeling all of this loan by loan. These are not aggregates. These are specific loans that are tracked, and then we're fitting models to their behavior. Next slide, please. So as part of the benchmarking data, we also have information on the site EUI. And so we fit basically exactly the same expression that I showed you before. And again, the sample sizes are small. We have a little bit more data on the site EUI. But we don't find that it has quite the explanatory power that the source EUI has. The measurement of the site EUI is less precise. It appears in terms of forecasting default, and so it seems to perform less well. But the electricity price gap performs extremely well, as it did in the prior slide. The next slide, please.
Nancy, we have a question.
Sure.
So related to the time frame that these loans were looked at, somebody asked about the benchmarking data and that you guys looked at. Going back to 2000, obviously we don't have benchmarking laws in place.
That's correct.
That far.
That's correct. So we are looking at the benchmarking data for the end of the sample. So we're looking at the benchmarking data that we observed in the last round of benchmarking, which was 2015? 2014.
Yeah, and we can say a little bit more about that, I think, right at the end. That is one of the study limitations in terms of
definitely
a single annual snapshot of the proxy for overall efficiency.
What we would have loved is to have a snapshot year by year, and we tried that because we do have a short panel. And even on our short panel, we're getting very similar results. It's just that we have fewer observations, which is more difficult to make inference or make positive statements about what we expect to happen in the population. Okay, so the results here are that the site EUI does not have a statistically significant effect, but it has the right sign. The electricity price gap remains highly statistically significant, but both of them have economically meaningful signs in the sense that they have the right positive or negative. They're positively correlated with default, and the magnitudes of those coefficients are reasonable, at least for the electricity price gap, which is statistically significant. May I have the next slide, please? So the third analysis was to use the Energy Star scores that we have from these data. Again, for these buildings, not all of them have an Energy Star score, so we're losing a little bit of the data just in the availability of this particular explanatory factor. And we find, again, that it has the correct effect on default, and that the higher the Energy Star scores, the less likely you are to default. But the statistical significance is somewhat weaker, but that also is associated with a slightly smaller sample size, having to do with things and statistics that are relevant and important, but are not super important for us right now. May I have the next slide, please, which is summary. So this is the summary from the Energy Star regression. And again, we find that it's not statistically significant at 0.05, but it is at 0.10, which is a perfectly acceptable cutoff limit, and it has the right sign and the right interpretation economically. Again, the electricity price gap, which is, again, just to remind you, this treatment effect of what the building actually experienced in terms of its energy realizations and prices over time, is highly statistically significant, and both of them have the correct sign. So this is really the first study that we have found nearly on the planet Earth that shows in a highly rigorous fashion that there is definitely a channel here between both the relative efficiency measures having to do with source and site EUI and Energy Star, and the actual treatment effect, which were the prices experienced through the ISO region of the building. So I'm going to pass it now to Paul.
Thank you, Nancy.
Quick question. Hey, Paul. Nancy, can you speak a little bit about for the source and site study, site EUI studies, were building occupancy or any normalization measures factored into the variables?
So the source EUI is neither of them. The answer is no to both of them specifically. We do have occupancy data on the buildings. The problem with the, in fact, we have quite detailed lease information on the top tenant exposure on the buildings. The problem with the data are that we have less lease data, and so it affects our sample sizes, so we didn't use it. We have looked at the age of the building, and we find that it's not a highly statistically significant explanator of default, and so we didn't incorporate in that. But as we carry this study on, we're planning to use, we have a lot of covariates, we're only using a subset here, and we hope to get more deeply into the leasing data because we do have that data.
Okay. Cindy, anything else you want to catch now before we continue?
Yeah, does anyone have any questions for the analysis right now? Please go ahead and raise your hand or type into the chat box. All right, Paul, why don't you go ahead and I'll stop you.
Go ahead, and yeah, we'll have, thanks, Cindy, again. So this is Paul Matthew back, and I'm sort of the energy efficiency guy here. So my question is, as I can imagine many of you folks who are energy efficiency folks wondering, okay, so what does that mean in terms of, plastic efficiency characteristics and their correlation to default risk? So what we did was that, that's the question we're posing. What are the actual impacts on specific cases? So what we did was to develop a range of scenarios that have potentially different energy factor risks. So this would be different building types in different locations with different features, with different operations, etc. And for each of those, we'd like to determine what the consumption and price volatility is, using some combination of empirical and simulation approaches, and then actually use the hazard model coefficients, those coefficients in the table that Nancy presented, to determine the actual impact on default risk. Next slide, please. So again, these are for initial insight. So just as an illustrative case, what we selected office buildings, and we looked at large office buildings because those are the buildings that are in the loan data set that we actually analyzed. So these are very large buildings, 500K square feet, as you can see. We looked at two climate zones. 4A, sorry for the cryptic nature of the climate zones here, but 4A essentially refers to the New York climate zone, and Washington, D.C. for matter, and 2A refers to, say, Houston. And then we looked at 3 levels of asset efficiency. That's the fixed asset efficiency, the windows and the walls and the roofs and the HVAC systems and so on. A high efficient building was one that approximately meets ASHRAE 90.1 2013. A medium was one that meets 2004, and a low would be one that has essentially a pre-1980s envelope. Next slide, please. So we ran, for each of these, so those are the asset types. Now, for any given asset type, whether it's high or medium or low, you can then have a range of factors that affect year-to-year energy use variations. And if any of you have been involved with building commissioning, you recognize all these parameters that can affect building energy use, operational energy use. I'm not going to go into them, but it gives you a flavor. There are things that are managed by facilities, factors that are affected by facilities, factors that are affected by occupants, or just maintenance procedures, of course, year-on-year weather variations, as well as vacancy rates within the buildings, and how you manage vacant spaces. Do you actually turn things off? Do you leave the lights on in vacant spaces, and so on? So next slide, please. So what we sought to then do was we took a subset of these factors and we said, okay, so let's say you have a building, again, no changes in the assets. I'm going to take each of these operational factors and kind of define 3 levels of practice that we're just, roughly calling average practice, good practice, and poor practice. And we can debate whether these truly do represent good or average or poor, but the point is that there are 3 different levels of practice. We then went ahead and modeled those. We simulated those, and if you can go to the next slide. Here is sort of a very quick high-level summary of what they look like. The column on the left, the 3 charts on the left show the data for the 4A climate zone, that's New York climate zone, and the columns on the right is the 2A climate zone, that's Houston. The top row is a medium asset efficiency, the middle row is a low asset efficiency, and the lowest row is a high asset efficiency. And I just want to point out a couple of key things here, because the details of the data and the numbers are not actually that important. The key thing is that even some, what may seem to be pretty small operational factors can have a pretty big impact on, what we're looking at is total source energy use variation compared to average. So the red bars represent, how much source energy use increases for a given variable relative to average practice, and the green bars represent how much it would reduce with good practice. Again, for a given asset type and climate location. And you can see lighting controls, thermostat settings, and VAV minimum flow settings can have up to 8 to 10% impact on total source energy use intensity as a percentage variation. And some others may be smaller. And again, any given building, your mileage may vary, of course, but the point is these are notional in terms of give you a sense of the order of magnitude differences. And those who've done commissioning will kind of recognize some of these numbers, which is that, yes, from commissioning you can get these kinds of variations, basically. Next slide, please. So then what we did is that we sort of just kind of combined those together and created, if you will, more outlier scenarios, or bounding scenarios, if you will. So which is that imagine a building that has poor practice across the board for those factors, or a building that has good practice across the board for those factors. Here's what the range looks like. So it varies anywhere from, 30 to 40% increase in source EUI just for those operational factors. Remember, this has nothing to do with asset changes. This is strictly operational factors, and an improvement of between 10 and 15, 20% for if you actually do good practice. So given that those are kind of notionally what can happen just from operations, how does that translate to default risk? Next slide, please. Oh, sorry, before I go on, weather as well. We looked at year-on-year weather changes, and actually, and we've known this also from some previous studies, the impact of year-to-year weather variations on total annual source EUIs is actually pretty small. As you can see, these numbers are, we looked at running these buildings for, with actual year weather data for 2000 to 2015, and the extreme, the max and the min were plus minus 1 to 2% max. And we've known this, yes. Seasonal variations may be much more. So just your variation cooling over the summer can be different, can be much higher. But if you look at total annual energy use, it's actually pretty small. Next slide, please. So this is our one takeaway slide, if you will, which is, okay, so what's the net impact on default risk? So again, I've just provided a very simple scenario here. Imagine we have a baseline with a source EUI of 200 kBTUs per square foot per year. Poor operational practice, as we showed based on some of those previous simulation studies of say plus 30%, could be 40, could be 20, and good could be say minus 10%. Based on the coefficients in the hazard model, the absolute change in default risk would be as numbers that you see there, 0.0084 for the poor and negative 0.0034 for the good. And the average default risk in the TREP data, Nancy tells me, is essentially about 8%. So if you look at 0.008 relative to 8%, that's essentially a 10% increase in default risk just due to poor operational practice. And I would say this is actually a conservative estimate because we didn't even look at a whole range of operational factors. We looked at really a subset of operational factors. So this is significant. We think that these are real numbers that are worthy of the attention of underwriters and lenders. Next slide, please. Okay, important to note limitations. This is currently limited to the CMBS market, commercial mortgage-backed securities, that is. We do use proxies for energy cost. Remember, what actually drives NOI is of course cost, but what we're using is source EUI, which is of course very close to cost, it's one step removed, and wholesale energy price gap. The source EUI data, as the question came up earlier, is an annual snapshot. So to some degree, what we're saying is that essentially that is a proxy for how that building may have been operated over the previous 3-4 years, which is, it's a reasonable proxy, I would say, but it is a proxy. We didn't use the actual source EUI month to month matched with the loan data. And of course, our data set is limited by scope, by location, by building types and sizes, and so on. So we'd hope to expand it with additional data. Next slide, please. So looking ahead, on the analysis side, we'd like to do default risk analysis using RCA bank loan data. We can say more about that during the discussion period, maybe if a question comes up. And then in terms of the actual impact, we envision a year or 2 years from now, we'd actually have almost like an actuarial style lookup of energy risk, key asset and operational characteristics. Sort of just like you do, car insurance right now, and they ask you 10 questions, the color of your car and your age and your gender and things like that, and then they have a lookup based on risk characteristics. For that, imagine we could do that with key asset and operational characteristics. That's, I think, where we'd like to get to truly operationalize it. So that's on the analysis side. We, of course, want to disseminate it. This is the first time we're actually sharing these results. So we're pretty excited about that. But we'll obviously want to do many more webinars and conferences, and of course we'll be producing a pretty hefty technical report as well on this. And the primary audience really are obviously lenders and owners, but other stakeholders matter as well. And then here's the ask to everyone. We would like to engage lenders and owners to do two things. First is to develop methods and procedures to fully incorporate these energy factors into mortgage valuation. We've now made the case that they're worthy of inclusion, appropriate inclusion, and we'll of course do more analysis to kind of strengthen that case. But we'd like to start working on actually incorporating it properly, both the volatility and the use levels, and then actually try and apply them on a couple mortgages and document them in case studies. So if you think there's an acquisition coming up that would be a good target case for this, we'd love that. And there are a couple of other areas as well that we work on mortgages. So we would request that you contact Cindy to, if you'd like to participate in any of the activities related to our commercial mortgage work. And Cindy's email is here on the slide, and again, we'll be sending these slides out after the webinar. Next, please. I think that might be the end, actually. Oh, yes, some acknowledgments. We'd again very much like to acknowledge Holly Carr and Cindy at the US DOE for tolerating us and supporting this effort. And then also the other team members of the overall mortgage effort. This was just one piece of it, this underwriting analysis piece. But we have several work going on PCAs. That includes colleagues at LBNL as well as at the Institute for Market Transformation. So thanks to them. And I believe that is definitely the last slide. So if you can just go to the next slide, that just says thank you for listening. We appreciate your attention, and again, welcome your questions, of course, now about the analysis, but also we very much welcome your engagement with us going forward. Okay, I guess we can go to questions.
All right, great. Thank you, Paul, Paolo, and Nancy. I actually have a question for the audience members that are still online. If you wouldn't mind just typing into your chat box, now that you've seen this presentation, who do you think are good audiences for us to reach out to with our analysis and our ask for participants? And could you mention if there are specific roles in your organizations who might be really good points of contact for us to reach out to? If you all don't mind just typing that into the chat box, that would be really informative for us. Now I have another general question. how do you plan to incorporate energy factors into mortgage valuations? Will this be voluntary, or will it have to be approved by regulations? So if you wouldn't mind talking about that a little bit.
Nancy?
So that's a very good question. We have, as a team, been thinking about this problem for quite a number of years. We had an earlier grant from the Department of Energy that was completely focused on valuation. The valuation mortgages are priced, how we say, actuarially, as Paul said, with a lot of empirical data. And basically, it will be the bond market that dictates what's incorporated. And the way the bond market works, so the market that buys the mortgages from the banks, or the way the banks are regulated to risk manage their mortgages, is as this information becomes more available, given that we've shown it moves the needle. Once you know it moves the needle and you're a risk manager, the banks are the residual claimants on this risk. And so their incentive should be to mitigate the risk. And what does that mean? Well, it means that for a building, if we can get a modification in, say, the PCA, so there's a simple ratio that shows a building relative to others, or say use the source EUI, a lender could modify the contract rate that's offered to a borrower. Or a lender might, if you have an especially attractive source EUI or say Energy Star score, given this actuarial table that Paul was talking about, a lookup table basically of risk, a lender might be willing to offer a lower loan-to-value, or a higher loan-to-value ratio. So these trade-offs, lending is done off menus. These menus are set up based on statistical analyses of what the relationships are between, say, loan-to-value ratio or contract rate or debt service coverage ratio and performance. So with studies such as these and others that will be done as more benchmarking data are available, lenders will have a rationale, a logic for how they do their pricing, and it will incorporate this information, which will be very valuable to them because they literally are blind to energy use in buildings right now. They don't have a way to see it. So defaults happen, and the causality through this channel is simply not acknowledged or represented in the risk analytics that either the banks do or the regulators look at in terms of understanding the balance sheet.
So Nancy, but you envision that that again, it'll happen kind of the banks doing it on their own. It wouldn't be necessarily from a regulator telling them.
Oh, absolutely. I mean, regulators don't do this.
Yeah.
I mean, what regulators do is say, you have to hold X amount of capital given the risk of your balance sheet. And so the bank's job is to establish the relative riskiness of their balance sheet. All of that reporting comes from the banks to the regulator. And so as this information is incorporated, and banks have a way of sorting borrowers in a fair way, given inefficient buildings seem to be more prone to default, and it could be an array of behaviors having to do with the way they operate the building that are measured on our scale by things related to energy, but it gives the banks a way to sort good borrowers from bad borrowers, and that's always good for the banks.
All right, great. Next question, which might also be a suggestion. Have you done any back-of-the-envelope estimate of the value to the commercial mortgage-backed securities market in avoided losses if they were better able to understand how energy costs and features of buildings could factor in to default?
So that's a great question. I love this question. The answer is, from our last DOE grant, we absolutely have that apparatus to do that. And that's the big benefit of these data, and that every loan that we're looking at is a member of a pool, and we have all the bond data and all the pricing data for each of these bonds. So we can absolutely connect the dots in this study between the loan market and the bond market. And because the bond market is so important for the commercial loan market because it gives the banks the liquidity they need when they decide to offload loans, this is a very, very big question, and which is another, I think you're picking up on some of our optimism about these results, that these are strong results. And so these results can definitely be taken to the actuarial question having to do with the pricing of the bonds. And we have the apparatus to do that. Now that we've connected the dots on the energy side to the loans, we have all the data from the loans right directly to the bonds. So we can definitely answer that question.
Do you have any plans to expand this analysis to multifamily properties and then to take this information to Fannie, Freddie, and HUD?
We love these questions. The answer is definitely. So as you can see from the analysis we're doing here, I'm not showing you the multifamily results, but we have multifamily results, and they're essentially the same. We're a little more worried about the multifamily results because the human factor is such a big effect in multifamily. We've talked to Fannie and Freddie, and definitely once we've established this move the needle component of this analysis, as Fannie does more with their multifamily programs and collects data, again along the lines of having the source EUI for the buildings, this absolutely could be replicated on Fannie's portfolio.
If tenants are paying the utility bills and energy bills, wouldn't the impact of higher energy usage and prices on an owner's default be at best indirect and likely minimal?
So this is a good question, and the jury is kind of out on this question, but in an earlier study, I had a very large financial institution give me all the leases from a commercial real estate mortgage-backed securitization. So these were thousands of leases, and we actually analyzed the leases for the bank. And leases are just another form of fixed income security, and the mortgages are basically a delivery mechanism for the risk in the leases. And so if the tenants cannot pay the energy costs, I mean, they're the ones that are being treated with these higher costs, and they're the weakest link in this chain. So you do get these groupings of, I mean, it depends obviously on the diversification of the leasing portfolio and given buildings, but we have information on the leases. So that's another set of dots that, we haven't done it yet, but from earlier work, I know absolutely that the leases can be priced in exactly the same way. We aggregated up for that deal for this institution, and now that we're dealing with the CMBS loans, the TREP data has a lot of information about the leases. So for these same buildings where we have source EUI, we've tried with the leasing data. We have good leasing data for about 300 buildings approximately. The results are the same, that's the good news, but we haven't dug into who those tenants are and what their situation is. But the TREP data gives us good information about the performance of the tenants and what those lease performance data are. We just haven't done it yet with these new merged data. But a lot of really interesting questions that we can tackle very directly here and then have a better answer for how indirect this is. My hunch is, from working on the leasing data, that it's much less direct than you might suppose.
Okay, great. Here's a comment that I think you might want to respond or reply to. It's related to commercial PACE. Most states that have approved commercial PACE require mortgage consent. Commercial PACE is specifically to finance energy efficiency and renewable energy projects for commercial and industrial properties. This would be a useful analysis to justify what in reality is additional debt on the building, albeit deemed off-balance sheet debt.
So you're talking to people in Berkeley, California, the birthplace of PACE, and we have thought about this problem a lot. But getting the data for PACE programs is in its infancy, and we just need more experience data before at least the type of work we do is going to have more to say on that. I mean, I think both the GSEs and also the commercial lenders have realistic concern about getting some kind of an actuarial fix on what that means in terms of their first positions. I think they're willing to give leeway right now, but actually quantifying that, I don't think we're there yet. I don't think the data sets exist, at least to my knowledge.
Okay. Do we have any other questions or comments from the audience? If not, this session has been recorded and we will post it online on the Better Buildings website. I think all attendees will get an email once that is done too, if you guys want to review or forward this session on to any colleagues that weren't able to make it today. All three speakers have their email contacts up on the screen right now if you have any individual questions and want to follow up. Any last comments from the speakers?
No, just like
no. Thank you for attending.
Thank you for attending.
Thank you very much.
All right, we'll give you guys 5 minutes back. Thank you.
Thanks. Bye.